Hey everyone, how's it going? This is Richard from Traderline, and in today's Tuesday tutorial, we'll be talking about how to tell if buyers or sellers are in control using closing ranges. So here's a little bit about what we'll cover. First of all, what are closing ranges, the tug of war between buyers and sellers, multi-time frame analysis, relative strength tips, weekly base analysis, and of course, key takeaways. So first of all, what are closing ranges? Basically, it places the closing range in context within the overall trading range of that particular bar. So here we've got an OHLC bar. This is the low, the high, this line off to the right is the close, and this is the open. And the closing range basically gives a representation of where this close is within the range from the high to the low. So here is the mathematical formula here, the close minus the low divided by the high minus the low. But basically, if the close is close to the high, the closing range will be near 100%. And if it's further down near the low, it will be closer to 0%. And this bar can represent the trading range of an entire year, a month, or even just 1 minute. All that matters is where that closes with respect to that total range. And you want to think in percentages, and the higher the closing range, the stronger the buyers were, and the lower the closing range, the closer to 0%, the stronger the sellers. So that's basically what I mean when I say the tug of war between the buyers and the sellers. If you think about this tug of war match being one single bar, with these being the buyers and these being the sellers, if the buyers are able to pull that close towards the high of the day, towards the left, that means the buyers are in control. But if the sellers went out and the closing range ends up being very low, 2%, 5%, that means that sellers were stronger on that day. And another thing to consider is that if the entire trading range is very, very tight, that suggests there's not really any direction. Neither the buyers or the sellers are in control. It's more about consolidation. So moving forward, it's also important to consider multi-time frames when you're talking about closing ranges. And in general, the higher the time frame, the more important that closing range is. So a yearly closing range is going to be more important than a daily closing range, a 1 minute closing range for sure. And it's also important to consider the volume on that particular bar. So if you go back to this analogy here with the tug of war, the volume on a particular day basically gives you a sense of the number of participants. And if there's a lot of participants, that suggests that institutions are involved on that bar. And basically, the higher the volume and the stronger the closing range, the more relevant that bar becomes. So moving on to some relative strength tips is also very important, and there's a great way to find the leaders in a market, especially when there's a lot of weakness. Basically, high closing ranges are a sign of relative strength, especially when the overall indexes and a lot of stocks have poor days. So if there's a deep red day, basically sort by strong daily closing ranges. That's what DCR stands for. And those stocks with daily closing ranges of over 50, 75% when the indexes are down 2% and have daily closing ranges of 20%, 10%. These are the standout leaders on that particular day. And you can take this up a notch and basically look at a weekly time frame, a deep red week. A strong weekly closing range once again reveals relative strength. Also, after gap down opens, focus on stocks with strong daily closing ranges in the first 30 minutes, hour of the day. Those will be the stocks showing relative strength. And weekly closing ranges are also very useful when you're analyzing a consolidation, like over here with ASAN, and trying to determine basically whether there's accumulation or distribution within a base. So what you want to consider is the weekly closing range along with volume to basically reveal accumulation versus distribution. And in general, during a correction, a greater than 40% weekly closing range indicates support by institutions. And what you want to do is walk bar by bar within that base and determine and count how many bars of accumulation versus distribution exist. So to use this example, here is the closing range on any given week plotted. This blue line is 40. So anything above it or pretty close to above it suggests accumulation. Anything below it suggests distribution when paired with the volume. And basically when you're looking at the volume, what you want to consider is the 10-week moving average of volume. Anything above that moving average is pretty significant, and those are the bars you want to count. So first of all, the first relevant week is this one. The daily closing range, or actually the weekly closing range, isn't quite 40%, but it's very close, and we have a significant rally off the lows on higher volume. I would actually count that as accumulation, so that's 1 to the accumulation side. Then the next bar, we have a weekly closing range of over 40% once again on high volume. Not a great close, but still accumulation. So that's 2 for the bulls. Then we have a week with a very poor closing range, as you can see down here on very high volume. So that's 1 for distribution, and so on until you get to right here, because all these volume bars are below the moving average. And then you have 1, 2, 3, actually 4 weeks of accumulation on higher volume, not super high volume, but you do see it being above average. So basically within this base, there's only 1 really bad week of distribution to about 6 weeks of accumulation. And that is a great ratio. That's what you want to look for when you're analyzing a base. So this is very useful, especially when the general market is basically in a correction. Look at the bases, what has the best accumulation versus distribution weekly count. So here are some key takeaways. First of all, closing ranges reveal who is in control on a particular bar, buyers versus sellers. The higher the time frame, the more important that bar and closing range is. And also the higher the volume, the more important the bar, because there's more participants. And finally, weekly closing ranges are very useful for base analysis to determine accumulation versus distribution. So that's a brief run through of the closing ranges. Let me know any questions you have down below. And if you have any topics or concepts that you would like me to cover in a future Tuesday tutorial, let me know down below in the comment section as well. Remember, leave a like down below if you enjoyed, and subscribe if you're new to the channel. And I'll see you guys in future videos. Thanks.